Many of you know that my favorite dividend-focused ETF is SCHD, or the Schwab US Dividend Equity ETF. After all, it's a top 5 holding within my portfolio. And every single year, the ETF goes through its reconstitution, meaning there's a whole group of stocks that exit the fund and a brand new group that comes in. Not entirely, but this year we had 23 new additions and 23 exits from the fund. Today's video, we're going to take a look at all of those changes, focus in on the top changes and the new look SCHD to determine whether the ETF is still worthy of a buy or it should be passed on right now. But before we do me a huge favor, click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is Cashflow University. Many of you know that I love earning passive income with dividends, but something I love just as much is earning income every single week by utilizing options. And Cashflow University is the premier options community. Cashflow University is a great community, whether you're new to options trading or you've been trading options for a number of years. This community continues to strengthen and there's always something to learn. The approach that CFU and its teachers takes is more focused on selling options to generate income. Those strategies include covered calls, cash secured puts, and credit spreads. You can learn all of this within this great community. Right now, you can try out Cashflow University and get 25% off as they're having a spring sale. If you go to sign up using the link down in the description below and use promo code CFU25, that will give you 25% off right now. Be sure to check out the link down in the description below. All right, let's jump back into today's video, taking a look at this new look SCHD to determine whether it's still worthy of a buy. Let's begin first though, for those of you unaware of the process and how SCHD is built, and look at exactly the steps it goes through to determine which stocks are eligible to be within the fund. The fund does not include stocks like REITs or MLPs. To be eligible to be included in the ETF, eligible stocks must have sustained at least 10 consecutive years of dividend payments, have a minimum float adjusted market cap of 500 million or more, and meet minimum liquidity criteria. The index components are then selected by evaluating the highest dividend yielding stocks based on 4 fundamental base characteristics, which include cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Stocks in the index are weighted based on a modified market cap approach. No single stock can represent more than 4% of the index, and no single sector can account for more than 25%. This is at the time of reconstitution. This idea of reconstitution happens on the 3rd Friday of every March, so it's something that recently went on, only happens one time a year. Every quarter, though, there is rebalancing that goes through. They're just adjusting the balances overall, but there's no new stocks that are added and no stocks that are kicked out of the fund until reconstitution. The latest reconstitution involved 23 brand new stocks being added to SCHD and 23 stocks being kicked out of the ETF. Let's take a look at those, and we'll be taking a closer look at just the top 6 of each, the top 6 based on weighting. So let's begin with the top 6 stocks in terms of weighting that were kicked out of SCHD. Beginning with Broadcom, stock ticker AVGO. Broadcom had a weighting of 4.9%. It was the largest weighting in the old SCHD, and this was a sad one to see, but given the performance that Broadcom had put up in the past 12 months, with a stock up over 110%, however, those big gains resulted in a sizable drop in the dividend yield. Remember, stock price has an inverse relationship to the dividend yield. The second largest weighting that was kicked out was Merck, stock ticker MRK. It had a 4.4% weighting. This is another name I was sad to see go because it's a solid healthcare company, but the dividend yield had fallen to 2.3%. Third on the list, Automatic Data Processing, or ADP, had a 3% weighting. ADP is technically an industrial stock. It operates in the HR industry. That saw its stock rise nearly 20% in the past 12 months, and its dividend yield currently sitting at 2.2%. Fourth on the list that was knocked out was Blackstone, stock ticker BX, had a 2.6% weighting. Blackstone has had a fantastic past 12 months with the stock rising nearly 60%. and the dividend yield sitting at 2.5%. So as you can see, a lot of these that have been removed from the ETF are largely due to the outperformance, which has resulted in a lower dividend yield. Fifth on the list was Illinois Toolworks, stock ticker ITW. It had a 2.2% weighting, and the stock is up more than 15% over the past 12 months, and the dividend yield sits at just 2.1%. And the sixth largest weighting that was kicked out of SCHD this past March, or reconstitution, was 3M, stock ticker MMM. 3M had a 1.7% weighting, and this is not a name that was removed because of a lower yield or outperformance in the stock, as the stock was even over the past 12 months relatively, and the yield is quite high at 5.7%. However, dividend growth is a factor, and that has slowed drastically, down to less than 2% on average over the past 5 years. So those there were the top 6 largest positions removed in terms of weighting. That was the SCHD of old. Now let's take a look at the largest new additions for SCHD into the SCHD of new. Beginning with Bristol Myers Squibb, stock ticker BMY. It has a weighting of 4%. This is a stock that's been under pressure over the past 12 months, down 20%. And the yield has climbed to 4.4% with some solid upside in my eyes, so a nice little replacement for that of Merck. Next on the list was Hershey, stock ticker HSY, has a weighting of 1.2%. This is a name that I've been adding to in small increments as they have some sizable headwinds due to the skyrocketing cocoa prices, which I view as a short-term headwind. We will have to see how much of that cost is passed on to the consumer moving forward. The stock is down 20% over the past 12 months, but has a solid dividend growth and a solid yield at 2.8%. The third new addition, or largest addition I should say, is Cincinnati Financial, stock ticker CINF, has a weighting of 0.8%. Not a company that I follow all that closely, and over the past 12 months, the stock has climbed 15%, and it has a dividend yield of 2.6%. But this is a dividend king with over 60 consecutive years of dividend growth. The fourth stock that was added was Skyworks Solutions, stock ticker SWKS. It has a weighting of 0.7%, and the stock has traded sideways for much of the past year, down 4%. It has a dividend yield of 2.5%, but some solid dividend growth sitting around 14%, and some much needed exposure to the technology sector for SCHD. Fifth on the list was CF Industries, stock ticker CF. It has a weighting of 0.7%. Another stock I don't follow all that closely, but over the past 12 months, the stock has climbed 18%, and it has a 2.4% dividend yield to go along with a 7% 5-year dividend growth rate. And sixth on the list was Dick's Sporting Goods, stock ticker DKS. Dick's Sporting Goods has a weighting of 0.5%, and if you saw a recent video of mine, I covered Dick's Sporting Goods and the crazy move higher that the stock has made just days prior to entering SCHD. The stock jumped higher on earnings, and over the past 12 months, the stock has climbed more than 60%, looking very overvalued at the moment, although the company has solid dividend growth, but just a 2% yield. This is an interesting add at this point, I felt like. So there we just looked at the top 6 removals and the new top 6 additions. Broadcom and Merck were 2 large weightings that were removed. They were both in the top 10. The largest addition was Bristol Myers Squibb in terms of overall weighting and addition to the top 10 there. The others were quite small overall. Let me know down in the comment section which of those top 6 that we just looked at did you like best. So now that we've covered that, let's take a look at SCHD as a whole and take a look at the top 10 holdings of Anew. As you can see here, the top 10 holdings now are Texas Instruments, and there's Bristol Myers Squibb, followed by Lockheed Martin, PepsiCo, Verizon Communications, Cisco Systems, Chevron, BlackRock, Pfizer, and Amgen rounding out the top 10. The top 10 positions account for roughly 40%. The top 10 holdings feel more legacy-like, more mature, which has me thinking that the dividend growth, although it's been great over the past 5 years, and we're going to take a look at that here in a second, I expect that to really start decreasing over the next few years. So those are the top 10 holdings. Now let's take a look at what the sector breakdown looks like. As you can see here, financials is the top sector, accounting for roughly 17%, followed by healthcare at 15%, consumer defensive at 13.9%, industrials at 13.5%, and rounding out the top 5 is energy at nearly 13% exposure. So now let's take a closer look at the dividend. But again, this is backwards looking. So it's not incorporating all of these new positions right now. So make sure we take this info with a grain of salt. So again, in terms of the dividend, which is obviously changing moving forward, the ETF has a dividend that yields 3.3% with a 5-year dividend growth rate of 12%. Something, as I mentioned, that I believe is likely going to slow moving forward. So with all that, what are your thoughts on SCHD, the SCHD of New? Do you like the new additions? Are you bummed about some of the deletions for SCHD? And do you still believe that SCHD is worthy of a buy? I still think it can have a position in a dividend-focused portfolio. And the reason being is it has many high-quality companies. I do wish there was a little bit more of a human element that went into the stock picking selection process, but that's not the case here, so we can't complain about that. However, I still think it's a great complement to the likes of an S&P 500 ETF, or say a triple Qs where you're tech heavy, because SCHD doesn't have very much exposure to the technology sector. So when the technology sector is doing great and the communications services sector is doing great like we saw in 2023, SCHD is going to lag behind those. However, when things broaden out and you get a broad, healthy rally, SCHD is going to do just fine. So down in the comments section below, let me know. Do you prefer the SCHD of old, or do you prefer the SCHD of new? And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.